What happens when a decentralized community, one with no CEO, no central authority, fundamentally disagrees on its own future?
Well, you risk a kind of civil war.
Exactly. And then what happens when, right in the middle of that very public, very messy internal conflict, the entire world suddenly decides it wants to buy in, driving just massive speculation?
That was Bitcoin in 2017. It was really defined by this unprecedented duality. You had the most contentious, almost existential debate the protocol had ever faced.
Right.
And it was playing out against this backdrop of, well, financial euphoria that brought Bitcoin to global fame and really cemented its identity in the public eye.
Absolutely. So this deep dive, it's really about the year Bitcoin arguably grew up, but also kind of split apart, right? All at the same time.
Yeah.
We're going to unpack that internal battle for the soul of the protocol. We need to understand these hyper-contentious technical decisions that led to an actual network split.
And then we ride the wave of the external mainstream mania.
The speculative frenzy, the ICO craze, and that pivotal moment when Wall Street basically decided, okay, Bitcoin is too big to ignore now.
And by the end of this, you should really grasp not just that the split happened, but the sort of technical mechanisms, the nitty-gritty behind the victory of one side, specifically segregated witness, or SegWit,
Okay.
and also how that messy, chaotic, very public year fundamentally established Bitcoin's role as, well, the indispensable digital reserve asset for this whole new global ecosystem that was just starting to bubble up.
Okay, let's dive into this epic year. We should probably start with that internal pressure cooker first.
Yeah, so we need to just briefly cast our minds back to the core problem from our last discussion, which was a scaling dilemma. By 2017, the digital highway was just jammed.
Totally gridlocked.
Right. The network faced constant stress, and critics, both inside and outside the community, were repeatedly predicting failure. You know, it can't handle the load, it's going to collapse.
And this prediction, this it's going to break narrative, it's such a classic sign of disruptive technology, isn't it? When you look back, I mean, the sources point this out repeatedly with other networks.
Oh, yeah.
Experts predicted the internet would completely collapse under the load of Usenet messages back in the day.
Right.
And then again later when people started sending like email attachments, big files, the pipes will clog. It's that same kind of cyclical prediction of failure.
Precisely. And the core lesson of scaling, which you see play out in, well, all network history, is that successful networks succeed by continually failing to scale gracefully for the next big application.
Well, succeeding for the previous ones.
Exactly. The network is always, in a sense, almost broken or running at capacity. Because if it was running smoothly with tons of headroom, it probably wouldn't be growing fast enough to meet that new demand. So new solutions, they have to constantly emerge.
And this stress point, this constant traffic jam, it led right to the philosophical heart of the block size war, didn't it? This whole debate over transaction legitimacy.
Yeah.
Like, if the network is full, transactions naturally cost more. That's supply and demand. But the fundamental question became, do those high transaction fees legitimize all transactions simply through a market mechanism? You know, if you paid the fee, your transaction is valuable, end of story. Or do certain high-volume, maybe low-value transactions constitute quote-unquote spam that actually breaks the neutrality of the network?
And that's a dangerous path, right?
Yeah.
Because if you start making architectural choices that impose some kind of top-down judgment about what counts as spam, you're essentially imposing a centralizing choice. You're deciding which applications are legitimate.
It breaks the whole point.
It breaks the core concept of Bitcoin's network neutrality. The original design, the ethos, really favored the free market of fees to determine value. Let the users decide what's worth paying for.
So the community fractured, really fractured, over how to resolve this fee and capacity issue while trying to preserve that fundamental neutrality. And we basically ended up with two major camps, each deeply invested in their view.
Yeah, very ideological camps. On one side, you had what was often called the direct increase view, or the big blockers. Their argument was pretty straightforward.
Simple logic, yeah.
The bottleneck is immediate capacity, so the solution must be an immediate capacity increase. Just raise the maximum block size limit, make the highway wider. Problem solved, or at least kick down the road for a while. They really prioritized utility and, crucially, cheap fees for everyday use.
Okay, that's one side. And the other?
The other side was the upgrade view.
Oh.
This was championed mainly by the Bitcoin core developers. There are also many long-term users and people running their own nodes. Their priority was decentralization. Meaning keeping the block size small enough that pretty much anyone anywhere in the world could realistically run a full node on cheap, accessible hardware, like a Raspberry Pi or an old laptop.
Mhm.
They didn't want it to become something only data centers could manage.
So they favored complexity.
They favored complex technical solutions, ways to optimize the use of the existing space, and critically to move certain data or even entire layers of transactions off the main blockchain. And this is exactly where segregated witness, or SegWit, comes into the picture.
Okay, SegWit. It was defined in a few Bitcoin improvement proposals, right?
Hmm.
BIPs 141, 143, 144, and it was deployed as a soft fork, which is important.
A very important distinction, yes, a soft fork. And the name segregated witness is the key.
Let's really unpack SegWit, because this is probably the critical technical pivot point of 2017, maybe in Bitcoin's history. We know it segregated the witness data, but why did moving that witness the signature data suddenly allow for more transactions? What was the clever bit, the technical accounting trick?
It's all about how the data was counted towards the block limit. See, previously, every single byte in a transaction, including the bulky, computationally expensive signature data that's the witness, counted fully toward that strict 1 megabyte block size limit. Now, SegWit was a soft fork. That meant it had to be backward compatible. Older nodes, nodes that hadn't upgraded, still needed to see blocks as valid according to the old rules. They couldn't just arbitrarily raise the 1MB number that would have been a hard fork, requiring everyone to upgrade.
So they couldn't change the size limit directly. They had to change the rules for measurement inside that limit. Is that right?
Exactly right. They introduced a completely new metric, block weight. The new rules stated that a block could not exceed 4 million weight units.
4 million weight units instead of 1 megabyte of data.
Correct. And here's where the segregation provided the efficiency gain. The main transaction body data, who's sending, who's receiving, how much that was counted at a rate of 4 weight units per byte. Still quite heavy.
Okay.
But the segregated witness data, the signatures that prove ownership, that was only counted at 1 weight unit per byte.
Wow, okay. That is a massive difference. You're essentially discounting the cost or the weight of often the largest part of the transaction by 75%, but only if you use this new SegWit format.
That's the absolute key. By moving the signature data into a separate structure and then discounting its weight contribution, a SegWit-enabled transaction could effectively consume, up to 4 times less space in terms of this new weight limit.
Allowing the actual 1 MB physical block to hold significantly more transactions, potentially up to almost 4 MB worth under ideal conditions, but without breaking the old 1 MB rule for non-upgraded nodes.
Precisely. It was a really masterful accounting trick. It preserved the 1 MB rule for older nodes, which maintained the backward compatibility needed for a soft fork, while still achieving a significant scaling increase for newer SegWit-aware nodes and wallets.
And this innovation, it naturally required introducing new address types, didn't it? We started seeing these addresses beginning with BC1 for native SegWit alongside the older 1 and 3 addresses. Those were the pay-to-witness public key hash, P2WPKH, and pay-to-witness script hash, P2WSH formats.
Yes, exactly. Those new address formats were the necessary signal, the policy implementation. They told network, hey, this transaction is using the new efficient SegWit structure. Count it using the weight rules.
And getting this upgrade activated, that was a whole drama in itself, wasn't it? Coordinating a soft fork like this, it required a supermajority of miners to signal they were ready. They used version bits in the blocks they mined, following rules like BIP8 or BIP9.
It was a huge coordination challenge. The requirement was often set extremely high, like 95% of hash power signaling readiness over a specific period.
Wait a minute, though. If the goal of the small blockers, the SegWit proponents, was primarily decentralization and preventing centralized control, wasn't forcing a 95% consensus threshold among miners essentially centralizing the decision-making power, at least temporarily, in the hands of the largest mining pools who controlled most of the hash rate?
That's a deeply insightful critique of the whole governance process back then, and it was absolutely debated fiercely at the time. While the idea of consensus is inherently decentralized, the specific mechanism chosen to measure that consensus, like BIP9's miner signaling requirement, arguably did concentrate immense power, or at least veto power, in the hands of those major mining pools.
Because if a few big pools didn't signal, the upgrade stalled.
Right. When activation needs such a high threshold, it really does illustrate how difficult coordinating upgrades can be in a decentralized system where financial incentives and ideological beliefs diverge so sharply. It gave miners huge leverage.
And the ultimate outcome, because the big block faction fundamentally disagreed with this SegWit-first approach, prioritizing immediate capacity instead, they refused to adopt it.
Right.
And they initiated a chain split.
That's right. They decided to force the issue. And this is where we need to be really clear about what a hard fork is. It's a permanent split. It's a non-backward compatible divergence in the blockchain's consensus rules. Nodes running the original rules, the Bitcoin core rules with SegWit activated, will actively reject blocks created under the new big block rules, which became Bitcoin Cash.
Yeah, so you end up with two separate chains running on two incompatible protocols, and therefore two distinct cryptocurrencies sharing a common history up to the point of the fork.
Exactly. And the source material, it breaks down the stages of a contentious fork like this, and it's quite a fascinating look at network governance under extreme pressure.
What are the stages?
Well, you typically start with a software fork. Someone creates a new version of the client software with the different rules, in this case, the Bitcoin Cash client.
Okay.
This quickly leads to a network fork. Nodes running the new software intentionally disconnect from nodes running the old rules because they know they're incompatible.
Then the miners have to choose.
Precisely. You get a mining fork. The total hash power of the network splits, with miners deciding which chain they believe is more valuable or viable to mine.
And finally,
the chain fork itself. The ledger permanently splits. This happened for Bitcoin and Bitcoin Cash in August 2017. Two separate histories began from that point forward.
and the survival, arguably the dominance, of the Bitcoin core approach, prioritizing SegWit and laying the groundwork for future technical layers rather than just increasing raw throughput on layer one that was monumental, wasn't it?
It truly was. It demonstrated the networks, or at least the majority coalition's, commitment to prioritizing decentralization and trust minimization at the base layer, even if it meant accepting higher fees and lower immediate transactional efficiency compared to what the big blockers were promising with Bitcoin Cash.
They essentially chose to be the secure foundational settlement layer, like digital gold, rather than trying to be the cheap everyday payments layer, like digital cash, on the main chain itself.
That's a very good way to put it. That decision set the course for Bitcoin's future development towards things like the Lightning Network.
Okay, now here is where the story gets, frankly, bizarre. Even as the core developers and the community were fighting tooth and nail over the fundamental architecture, the network was literally splitting in two. The outside world, the mainstream, suddenly decided to place this massive, incredibly noisy, and wildly enthusiastic bet on Bitcoin's immediate success.
Yeah, 2017 was the year the price just went completely parabolic. It started the year under $1,000.
Incredible to think now.
Isn't it? And by December, propelled almost entirely by external attention and pure speculation, it was pushing close to $20,000 on some exchanges.
And this wasn't driven by some sudden massive improvement in the tech, right? SegWit was activating, but the full benefits weren't immediate or universally adopted yet.
Not at all. It was driven almost purely by market mania, external hype, new money flooding in.
This external reaction, it really reminds you of how disruptive innovation is almost always treated initially, doesn't it? The sources draw this really fascinating parallel to the introduction of electricity.
Ah, the electricity analogy, yes.
The media back then didn't announce, hey, this is brilliant, decentralized power for everyone. They said it was dangerous, it would burn down people's homes. They ran story after story about electrocutions and fire hazards, focusing entirely on the risks and downsides.
Exactly. The initial reaction to any noisy kind of crazy new idea is almost always resistance, ridicule, focusing on the flaws, the immediate dangers.
Yeah.
The innovations that succeed are the ones that persist through that noise.
Until eventually everyone else kind of realized, oh, wait, that revolutionary idea, whether it's decentralized power distribution or decentralized value transfer, was actually correct all along.
Right. And what was driving this frenzied speculation in 2017, it wasn't really current utility, especially with fees sometimes getting quite high during the peaks. It was anticipation. It was, as the sources call it, a shared cultural hallucination.
That phrase really captures it, doesn't it? The psychological element of that 2017 bubble.
It does. Bitcoin's speculative value during that bull run was derived primarily not from its intrinsic day-to-day usefulness at that exact moment, but from the collective, shared assumption that other people would continue to accept it and value it even more highly in the future.
It's a kind of self-fulfilling prophecy based entirely on future expectation and belief in the network effect.
Exactly. Belief that the network would continue to grow and demand would continue to increase.
But that raises a kind of philosophical question, doesn't it? If the value is largely psychological, this shared hallucination,
Yeah.
does that imply the value is somehow fictional or not real? How do you reconcile that psychological aspect with the hardcore cryptography and security of the network itself?
That's the inherent duality of Bitcoin, and maybe all money, right?
Hmm.
The price is certainly subjective and driven by psychology, market sentiment, adoption curves. It's fictional in the sense that all currency value is ultimately based on collective agreement. But the integrity of the asset itself.
The fact that your private key controls your coins.
Right. The fact that your key controls the coins, and no government or bank can unilaterally seize them if you secure your keys properly, and the scarcity, that hard cap of 21 million, is enforced by mathematics and the consensus rules, that part is entirely real and verifiable.
So the shared hallucination is about the price, but the cryptographic proof is about the security and the ownership.
Precisely. One is about market dynamics. The other is about the fundamental properties of the technology.
And the drivers of that market mania in 2017 were just relentless, weren't they? Intense media coverage focusing almost exclusively on the skyrocketing price.
Every news channel, yeah.
Pervasive retail fear of missing out FOMO on a massive scale. And just this endless stream of stories about early adopters becoming overnight millionaires.
And that intense coverage, it consistently confused the medium for the message. The media outlets overwhelmingly treated crypto or Bitcoin entirely as just another financial commodity, like a super volatile stock. They almost completely missed the underlying cryptographic and network protocol revolution. They didn't grasp the core innovation, which was trust minimization through decentralized consensus. They just saw a ticker symbol going up.
And here's the central, almost painful paradox of 2017. This explosive speculative adoption, all this new money pouring in, it placed immense, agonizing stress on the actual Bitcoin network, which for most users was still running on the pre-SegWit architecture or hadn't adopted SegWit wallets yet.
Absolutely. The mania created this chaotic feedback loop. The more the price went up, the more people wanted to buy or sell or move their coins.
Just clogged the network.
Which clogged the limited block space, driving fees higher and higher and making confirmation times longer and less predictable. It forced users to directly confront the exact scaling issues that were simultaneously dividing the community in the block size war we just talked about.
So the bull run itself, fueled by all this external hype and speculation, ironically ended up validating the concerns of those pushing for immediate block size increases, like the Bitcoin Cash proponents.
Because fees were high and usability suffered.
But it also simultaneously strengthened the argument for the more sophisticated off-chain or layer 2 scaling solutions that SegWit was designed to enable, because it showed the base layer couldn't handle that kind of load cheaply.
Exactly. The drama was playing out in real time, right there in the network fees and confirmation times that users were experiencing. It was a stressful but ultimately spectacular test of the network's resilience under fire. And the financial euphoria, the craziness, it didn't just stop with Bitcoin's price itself. 2017 was also the absolutely explosive year of the initial coin offering, or ICO, craze.
Right, the ICOs. Thousands of new projects suddenly appeared, all leveraging cryptographic principles, creating this absolute explosion of what were often called alt currencies or tokens.
And this parallel explosion, it really reflects a potentially massive philosophical shift, doesn't it? The sources suggest we were seeing the very idea of currency maybe moving away from being issued purely top-down by nation-states.
Towards becoming more of a choice.
Yeah, becoming a choice, a decentralized means of expression, or even an application in itself, tailored for specific communities or purposes.
How do you mean, like an application?
Well, think of it this way. Bitcoin was the original killer app for decentralized value transfer, kind of like email was for the early internet. It demonstrated the core power of the new medium.
Okay, the foundational layer.
Right. But once that base layer technology exists and proves itself, it enables 1,000 other more specialized applications to be built on top or alongside it. Things like instant messaging or streaming video, or in the crypto world, specialized tokens for smart contracts or decentralized storage or specific online communities.
And we don't worry that, say, Twitter is going to destroy email because they serve different needs, different purposes.
Exactly. Likewise, many of these altcoins, these ICO projects, they claimed sometimes legitimately, often not to serve different specialized purposes beyond just being digital money like Bitcoin.
Okay, but regardless of their individual claims or merits or lack thereof, How did this massive proliferation of thousands of alt currencies directly impact Bitcoin itself during 2017?
Well, the primary impact, and this is a really critical point for understanding Bitcoin's role, was solidifying its position as the on-ramp and reserve asset for the entire ecosystem.
The main gateway. Why was that?
Because for the vast majority of these newly minted ICO tokens, if you wanted to buy into the sale, you couldn't just send dollars or euros directly to the project creators in most cases.
Right. That infrastructure didn't really exist yet or wasn't trusted.
Exactly. You needed the established digital reserve asset. You needed Bitcoin. You had to first acquire Bitcoin, and then you could send that Bitcoin to the ICO address to receive your new tokens.
So buying into ICOs meant buying Bitcoin first.
Could massively increase the demand for Bitcoin, purely as the necessary gateway, the primary trading pair. It cemented its perceived role as the digital gold or the base money for this whole emerging crypto economy. It was effectively the dollar of the crypto world back then.
And these new projects, they weren't conjured out of thin air, technologically speaking. They were building on the foundations Bitcoin had laid, using the same core ingredients.
Precisely. They were utilizing the cryptographic primitives that Bitcoin had pioneered and proven viable on a large scale. Things like cryptographic hash functions, digital signatures, primarily ECDSA at the time, though Schmore signatures were being discussed, and the basic structures for decentralized transactions.
So they were taking Bitcoin's core innovations, the fundamental building blocks,
And creating their own custom recipes or applications with them, sometimes adding new twists like different consensus mechanisms or smart contract capabilities. But this whole phenomenon, this Cambrian explosion of tokens, it really confirms Bitcoin's role as the foundational innovation. It was the core engine, the inspiration, that made all these subsequent cryptographic tokens possible, whether they were forks or built on other platforms like Ethereum, which also emerged around this time.
Yet, for the general public watching this unfold, it must have been total dizzying confusion.
Oh, absolutely.
The ICO market was notoriously risky, filled with outright scams, projects with no real substance, teams that disappeared after raising funds, and the media seemed completely unable, or maybe unwilling, to clearly distinguish between the different assets.
Yeah, the media routinely failed to make that distinction. They failed to separate the foundational, relatively well-understood, fixed supply, immutable Bitcoin protocol from the thousands of new, often highly experimental, incredibly risky, and sometimes centrally controlled ICO tokens.
Everything just got lumped together.
Everything got lumped together under the banner of crypto, which was incredibly dangerous for consumers and investors who didn't understand the vast differences in quality, security, and decentralization.
And this circles back to a kind of sociological critique that appears in our sources, doesn't it? This idea of elitism or maybe just pattern matching failure. The mistaken assumption that high cost or high control automatically equals high quality.
Exactly. Traditional media, operating in expensive, high-control mediums like print or broadcast TV, often mistakenly dismiss these new, cheap, open, decentralized mediums like crypto networks.
Because the cost of issuance was low?
Yeah, when the cost of producing or issuing something, whether it's information or a digital token, becomes near zero, people sometimes mistakenly assume the value of the thing itself must also be zero. They confuse the ease of creation of the medium with the potential value of the message or the asset being transmitted.
The established financial guard, the traditional gatekeepers, they clung to their old controlled mediums. They failed to grasp, initially at least, that the core message here, secure, verifiable value transfer, could now be transported over any medium, including these new open networks, at near zero marginal cost, instantly, globally, and without needing their permission.
And the ICO craze, for all its flaws and excesses, was really the first massive, chaotic, global demonstration of that raw, untamed power.
So, the story of 2017, it culminates not just in this spectacular manic price growth and the chaotic ICO boom, but also in a really profound shift towards mainstream legitimacy. The ultimate external validation seemed to arrive in December 2017, right near the peak of the mania.
Yes, that was when two of the world's largest, most established regulated financial exchanges, the CME, the Chicago Mercantile Exchange, and the CBOE, the Chicago Board Options Exchange, launched Bitcoin futures trading.
That felt like a huge moment at the time.
It was a seismic event, truly. It signaled that established Wall Street institutions, the heart of the traditional financial system, were finally ready or maybe felt compelled, to start integrating Bitcoin into the highly regulated global financial infrastructure.
And this was necessary, but also represented a fundamental challenge to how they normally operate, right?
A huge challenge. Traditionally, these institutions operate under a very strict client-server architecture. They are the masters. They control the ledger, they control access, they are the arbiters of truth within their systems.
Centralized control is the default.
Absolutely. Bitcoin demanded that they interact with a completely decentralized system, one with no central counterparty, no CEO to call, no headquarters to sue. It's fundamentally antithetical to their ingrained structure and risk management models.
So what allowed traditional finance, these massive regulated entities, to finally get comfortable enough to offer products based on this new decentralized asset while still meeting their own stringent regulatory and risk requirements?
It really boiled down to one core, unique feature of Bitcoin: trustless auditability.
Okay, unpack that. What specifically about Bitcoin provided that comfort level?
It's the fact that a Bitcoin transaction, which is actually just a small piece of data, maybe around 350 bytes on average, is essentially a self-verifying system.
How so?
Any node, anyone running the full Bitcoin core software with a complete copy of the blockchain, can independently validate the entire transaction history all the way back to the Genesis block without needing to ask permission from or trust any third party whatsoever.
And that is the absolute crucial difference compared to traditional banking, right? If you're a big institution, say, and you want to confirm a large wire transfer in the traditional system, you ultimately have to trust the internal ledger of the bank, or maybe a correspondent bank. You're exposed to significant counterparty risk.
Exactly. The risk that the other side of the trade won't or can't honor their obligations, or that the intermediary makes a mistake or goes bust.
But with Bitcoin,
With Bitcoin, institutional investors could finally gain exposure to an asset where the ownership rules and the transfer validity were enforced not by a central party, not by legal contracts alone, but by pure cryptographic proof embedded in that public distributed ledger.
so as long as the cryptography holds and the network consensus remains secure, that independent, verifiable public ledger effectively removes the traditional counterparty risk from the asset itself.
That's the core value proposition for institutions. The consensus system, the proof of work mechanism that secures the chain, creates this authoritative, globally consistent, trusted public record. For an institution, running their own full node gives them a completely authoritative, real-time, auditable view of the entire system state. And crucially, it requires absolutely no reliance on any potentially untrustworthy third party, no bank, no specific government agency.
It's that ability for independent verification.
That level of independent verification is ultimately what allowed Bitcoin to start maturing from just a fringe cypherpunk curiosity into something that could be seriously considered and eventually integrated as a global asset class. Wall Street effectively decided they could trust the math, the cryptography, and the incentives of the decentralized network, perhaps even more than they could trust relying on some unregulated counterparty in the nascent crypto space.
So the launch of regulated futures trading was the ultimate acknowledgement, maybe, that Bitcoin had succeeded in solving that Byzantine general's problem, achieving distributed consensus among untrusting parties in a way that had profound macroeconomic implications they could no longer ignore.
It really was. It forced the established system to start grappling seriously with the implications of decentralized consensus.
It's quite the irony, isn't it? The same technology that was partly designed to bypass the traditional financial gatekeepers ultimately had to be embraced and integrated by those very gatekeepers to gain that final stamp of global legitimacy and access for large pools of capital.
The institutions needed a regulated bridge to access the decentralized asset. It's a fascinating dynamic.
Hashtag tag conclusion.
So 2017, wow. Arguably the most consequential, certainly the most chaotic and spectacular year in Bitcoin's history up to that point.
Without a doubt. It survived a near-existential internal civil war over its future, its scalability, its core governance structure. That ultimately resulted in the contentious split that created Bitcoin Cash. And crucially, the main Bitcoin network proved its resilience. It managed to implement complex, arguably more forward-looking technical solutions like SegWit, choosing that harder path even while under immense financial pressure and public scrutiny.
They really did choose that path of difficult, layered scaling solutions over the simpler, perhaps more immediately gratifying block size increases, a defining choice.
And then simultaneously, it experienced that absolutely spectacular speculative wave. Mania that cemented its global fame probably established its role for good as the indispensable digital reserve asset, the digital gold for that burgeoning altcoin
That was
ecosystem.
on ramps.
And finally achieved a significant degree of institutional legitimacy through the launch of those regulated financial products on Wall Street. It forced global finance to actually start grappling with decentralized consensus as a real phenomenon.
Or whirlwind year.
Now, of course, that level of financial euphoria, that parabolic rise, it was inevitably followed by a crash, a pretty brutal one, and then the long, cold crypto winter of 2018 and beyond set in.
Yeah, the bubble popped, as bubbles tend to do.
The frenzy had shifted the public focus entirely onto price, but the crash, ironically, allowed the developers and the serious builders to shift their focus back to where it needed to be. Quiet, fundamental development, heads down, building out the infrastructure.
And importantly, that quiet development period could now leverage the technical achievement of SegWit. That highly contentious soft fork, the one that caused so much drama, it actually laid the essential groundwork, the foundation, for the complex second-layer solutions that could finally start to handle mass transaction throughput efficiently.
So, Bitcoin had reached the global stage. It survived a major fork, endured a spectacular bubble and crash. The world was definitely watching now. But the real work of scaling the network to meet that global demand had, in many ways, only just begun.
Exactly. The foundation was strengthened, but the house wasn't fully built yet.
Join us next time for the deep dive into what came next.
We'll explore that period of quiet building that followed the 2017 crash. We'll focus heavily on technologies like the Lightning Network, which directly leverages that SegWit foundation we discussed to achieve potentially millions of transactions per second with extremely low latency and fees.
And we'll also look at how major institutions started to transition from just seeing Bitcoin as a short-term speculative gamble driven by the futures market towards taking it seriously as a potential global macro asset, something to consider for long-term portfolios, even outside the immediate volatility of the crypto winter.
The ultimate stress test of 2017 was complete. The network survived. The question then became, could Bitcoin actually build the infrastructure layer by layer to handle the global demand it had already managed to create?
You won't want to miss our next deep dive as we explore the answers.